The first advance estimates from the country's premier statistics body, the National Statistics Organization, is flashing for you on the screen. It is a very big number compared to the poll we had. It's coming in at 7.3%. That's the first advance estimates for the current year. Remember, when the Reserve Bank first started estimating the current year's GDP, it had said 6.5, and a lot of people in the market thought that that was an ambitious number. Reserve Bank in its last policy upped the forecast for the current year to 7%, and now the country's premier statistics body is calculating the advance estimate at 7.3%. So that, I would guess, is the strongest number on the street. The next big estimate we have is from SBI. Soumya Kanti Ghosh looks at the GDP, estimates the GDP number at 7.2, the Reserve Bank at 7, and the CNBC-TV18 poll average of about 10 economists was 6.8%. So clearly, this number is an outlier, much higher than what the street was expecting. We also have the Informist poll that was 6.7, ours was 6.8, but the premier statistics body sees the number at 7.3. As I said, the nominal GDP number, however, is estimated at 8.9, exactly in line with what the CNBC-TV18 forecast was. Our poll also saw it at 8.9%. So nominal GDP is as per estimates, but real GDP is seen far stronger. I'll just spend a minute on why I'm harping on the nominal GDP number. The whole purpose of this exercise of the first advance estimates, or at least one prime reason for the advance estimate, is that you get the nominal GDP number for the current year fixed before the year ends from the statistics body, so that 3 weeks later, when the government meets for the budget, on this base, they estimate a nominal GDP for the next year, FY24, and a percentage of that will be taken as the fiscal deficit. That is why the nominal GDP number becomes very important in this particular announcement. Normally comes on Jan 7th, but since that's a weekend, we are getting this number on Jan 5th. It's traditional. Every year, the NSO gives this number on the 7th of Jan, so that 3 weeks later, the budget on the basis of this nominal GDP estimates the nominal GDP of the next year. Okay, that's the preface. I'll just quickly read out the other numbers. My guests are already with me. The services sector growth is seen at 7.7%. I think that's pretty close to what the CNBC-TV18 poll said. Services, ours was 7.4. The statistics body is putting it at 7.7. Industry is pegged at 7.9. That exactly was our forecast, or our poll. No, our poll is 7.7. So, just a minute. I'm sorry, I'm mixing it up. 7.9. Our industry estimate is also 7.9. So, industry growth estimate of the NSO, 7.9. Services, 7.7. That 7.7 is a little higher than our estimates. We also have other numbers. Private final consumption growth, as estimated by the NSO, is only 4.4%. I don't want to give our poll number because very few people gave me an estimate for that, but it came in at 5.7. I'm going by just 3 or 4 estimates. In any case, the NSO's number is far lower. Now, this is a bit of a disappointment. 4.4% is their estimate. Government final consumption expenditure is seen at 4.1%. Again, disappointing, but what's estimated very strongly is capital formation, GFCF as we call it, gross fixed capital formation. That's estimated 10.3% higher. It's of course been a strong capex investment both from the central government and the states, and that may account for this kind of an estimate. I'll quickly run through the other estimates. Construction is expected to come at 10.7. Our poll number also was very close to 10. Manufacturing sector at 6.5%. Mining 8.1, that's a big one. Farm sector is only 1.8. Our poll was 2%, and I thought that was poor. But the NSO's estimate is also 1.8. GVA growth is expected at 6.9. And GDP, as I told you, 7.3 real and 8.9 nominal. With those preliminary estimates, let me invite our eminent panel. Joining me now is someone who has guessed it very close to the NSO, Soumya Kanti Ghosh, the Group Chief Economic Advisor for State Bank of India. Also with us, Shubhada, the founder of QuantEco Research. And in a bit, we will be joined, I think, by Dr. Pronab as well. Soumya, bingo. That's a bullseye number from you. You were the only one with a 7+ number in our poll. But what do you make of the other estimates? Construction 10.7, manufacturing 6.5, more generally, services at 7.7 and industry 7.9. Are the estimates in line with yours?
Yes. Thank you, Latha. I think first, just let me make an observation is that I think there is a new trend now that the CSO estimates are higher than RBI estimates. Earlier, what used to happen was that the RBI estimate was higher than the CSO. But for the last 2 years, it has been higher by 20 basis points last year, and this year it is already 30 basis points higher. It could go even higher. So that's the first observation. Basically, the games have changed. The second thing is that basically, if you look into the overall number, headline number, we just calculated the number for the second half also. I think agricultural sector growth rate for the second half is expected to fall to around 1.4%. So that makes the full year growth rate around 1.8%. So that's a tad disappointing. But in terms of the industry, the second half growth rate is 6.7, which is against 9.3 first half. The service sector is actually holding up. It is at 7.5 against 8% in the first half. And total GVA, total GDP actually growth in the second half is at 7%. So basically the 7% maybe have become the new normal if you look into the data for the last 3 years. But what is more important is that if you look into the core GVA, a proxy for the underlying activity in the private sector, that has moderated in the second half to 7.1% from 8.5% in the last year. And so basically the data actually shows that the numbers are more or less in line with what we are expecting, because we were actually expecting that the numbers could go higher, and that has happened. But another important thing, which I think this is also estimates which we are trying to make out right now, I think because of this nominal GDP number, the government actually will now have elbow room to spend more without showing a commensurate increase in fiscal deficit. So that number could lie anywhere between 35,000 crore to 40,000 crore. So overall, the headline number is impressive at 7.3%. The second half growth rate remains at 7%, so that doesn't go below 7. And the third important thing, that the government gets the elbow to spend more, possibly spend more, without showing a commensurate increase in fiscal deficit. So all in all, I think there is reasons to celebrate regarding the numbers.
No, 1 minute. How are you saying that the government gets ability to spend more? Their GDP number, nominal GDP number, is 296 lakh crore. I distinctly remember the budget had said that they are expecting 301 point something, almost 302 lakh crore. So, if anything, on the margin, the fiscal deficit will have to be trimmed a bit, isn't it, Soumya? How can you say they can increase the fiscal deficit?
No, what I'm saying is they're not going to increase the fiscal deficit. The fiscal deficit, they will have a leeway to continue to have the fiscal deficit at the same level, without showing a commensurate increase because of the nominal GDP number. That's what I'm trying to say.
Fair enough.
5.9%, they get more leeway to spend without an increase.
Okay. Without any increase in the fiscal deficit, I don't see how they get more. Whatever, 16.6 lakh crore, the fiscal deficit will have to be around that number, I thought. But let me clarify another doubt. If Dr. Pronab Sen is with us, good evening, sir, and thank you very much. Dr. Sen, how is this estimate done? Since you have been there, done that as the chief statistician, the CSO has about 7-8 months of data, right? And they are projecting. Now, we all know that the second quarter was an extraordinarily good quarter. We got 7.6 when, the polls and the RBI were expecting a sub-7 number. So, do you think that this extrapolation may be belied? After all, there is evidence of rural demand not really picking up in the third quarter, especially in the last month, December. Likewise, urban is showing a little bit of flagging. So, is the CSO just an arithmetic extrapolation of the 8 months? Therefore, is it a likely overestimation?
No, it is pretty much an arithmetic extrapolation. So what they do is that they essentially go by the seasonality trends that have shown up in the past and use whatever data they have, which, as you said, it's about 8 months of data, to do the forward casting.
There was an RBI member who raised this doubt some time back, around the time when they raised their estimate. He said that it's possible that the CSO will give a strong number because the first 8 months have been strong. but that may not happen. You know, our 7 may be more correct than their higher number.
That may well be the case. But, the fact of the matter is that as far as rural demand is concerned, it wasn't doing particularly well in the first half of the year either.
Okay.
I don't think that changes anything very dramatically.
Okay. Samiran Chakravarti wrote a note today, Samiran from Citibank, saying that rural is stabilizing at a lower level than he expected. And also, I think the paper noted some signs of urban demand flagging. So I'm just wondering if, the 9th, 10th, 11th, 12th month are not as strong as the first 8 months. Is the NSO number likely to be an overstatement? That possibility exists, you think?
It certainly exists.
Okay. So coming back to you in a minute, Shubhada Rao, I read out all the numbers to you. If you want, I could do it again. Agriculture 1.8, mining 8.1, manufacturing 6.5, electricity 8.3, construction 10.7, trade, hotels, transport, that's the weak one, 6.3. Finance 8.9 and public ad, defense and other services 7.7. First thoughts, Shubhada?
I think it's definitely 50 bips higher than what we were estimating at 6.8% as an advance estimate. Very clearly, I do concur with Dr. Sen that due to the extrapolation basis first 8 months, we do expect some sobering down of these 7.3 numbers to somewhere close to 7 is what my estimate would be. As far as the breakup is concerned, pretty much in line with agriculture, construction, and also some of the services items or elements like trade hotels. We were actually spot on as far as trade hotels was concerned. Finance was, of course, much higher than what we anticipated, but broadly in line with what was being earlier discussed. I would think that the first 8 months have seen a very significant ramp up in the growth momentum, which if you look at the high frequency data coming from December onwards, shows some fatigue in growth across board. And that is the reason why I believe that perhaps in the final estimates, we could see a growth for FY24 coming close to 7% and not as reported today at 7.3%.
Okay. Madhavi Arora of Emkay is also joining us. Madhavi, I'm a little taken aback by the private final consumption expenditure. The NSO is estimating it at only 4.4%. Now, is that a cause for bother, a cause for worry?
See, any which way, if you look at the consumption pattern, it has been very patchy, right? The rural consumption has essentially been sort of, non-performer to a large extent if I really smoothen the data. And even the festive if I adjust it for seasonality, hasn't been very strong either. So, there's been still a very patchy urban versus rural story. And within urban also now you're seeing the division of the premium class versus the middle income strata. So I think to some extent the private sector consumption story hasn't been too robust. I think the first half has still been very good, partly on account of the fact that, we saw, leverage consumption, which was led by relatively easier financial conditions to some extent. And possibly the second half of the year would see a relatively tighter lending standards by the financial sector. So that would curtail a bit of a formal consumption pattern that, we saw booming in the first half of the year. But also, I think the, uneven consumption story has been, there since COVID. We've seen it overall improve from what we saw post-COVID. But still the kind of division in terms of how urban versus labor, and within urban, how the premium urban versus the mid-income urban is now behaving is getting a little more visible.
Okay. Let me come to others also on the same point. Soumya, is that a spot of bother? That when you look at GDP from the demand side, then consumption is found wanting. How long will people do capex unless consumption really picks up?
Just allow me to make one small correction. I think I said the government can increase. I think the government has to curtail the deficit because the nominal GDP is lower. So that's one small correction which I
Yes.
want to make before.
Thank you.
Specifically, 37,000 crore will have to be the expenditure compression if the fiscal deficit is kept at the same level. So just that one small
Point taken.
clarification. And now regarding the second thing, regarding the consumption, I think the story of consumption, if you look into it, if you look into the year-on-year growth rates, and if I look into the second quarter growth rates in terms of the investment looks solid enough. But consumption, I think what is currently happening is that if you look into a sequential basis, quarter on quarter, there has been some improvement. But if you actually look over the yearly data, there has been a slowdown. So my point over here is that while the consumption may be impacted to the extent that it is not at 7.5% for FY23 or 11% over there. So my point is that it is actually mean reverting. And from that point of view, it will be better to look through the numbers in terms of a sequential growth rate, because that will give you a better approximation of where we are today instead of the previous quarter. So while the point on this is well taken, my sense is that we may not be doing as badly as we thought of. And also regarding the extrapolation point which you made out, I think the extrapolation data is also nicely built into, because the agricultural sector is already mean reverting, because second quarter the growth rate is 1.4%. So what has happened over the last 8 months in terms of a rural urban story, possibly what people maybe think of, that has already been factored into the data, because rural growth is even lower than the first quarter, and that is at 1.4%. And overall full year growth is at 1.2%, I think, which is the lowest in the last 6 to 7 years. So from that point of view, I think the 7.3% growth rate, even though an extrapolation, could see some revisions later on, because I think on February end, the last year data will come out, and we may again see some revisions over there. So my sense is that, yes, these numbers are mostly in line with actually our expectations. We were expecting the number to be higher than the RBI of 7%, given the trends in deflator.
That's
right. But overall, this number doesn't look so, disappointing.
No, I take your point. What you're saying is it may be only trimmed a little bit, and that the rural slowdown is kind of factored in. After all, they're taking a very low estimate of agricultural growth at only 1.8. So to some extent, the NSO is factoring in the rural slowdown, or at least the lack of momentum in rural demand. Dr. Sen, would you concur? And your comments more broadly on consumption being as low as 4.4, and a large part of the GDP growth from the demand side coming from capex growth of 10.3%. Is this sustainable?
Latha, it frankly worries me. It has, at least to my memory, I don't recall such a gap between consumption growth and overall GDP growth. Normally, consumption growth has been near or even slightly above the GDP growth in the Indian context. And what we are looking at now is almost a 300 basis point gap. That is deeply disturbing. And it's something that I think requires us to apply our minds as to what is going on in the economy.
That certainly will be the stuff of discussions going forward, Dr. Sen, and we will need your inputs on that as well. But Nikhil Gupta of Motilal Oswal, in his book, The 8% Economy, argues that we perhaps must have higher capex than consumption for a period, so that we improve productivity and capacity, and then consumption should take off. Is that where the country is heading? Can this be a positive trend? I will come back with that question after a very short break. Back in a jiffy. Welcome back to our special State of the Economy show. The NSO, the country's premier statistics body, has just said that in their estimation, this year the GDP, the real GDP of the country will be 7.3%. That's the strongest estimate on the street. The State Bank of India estimate is 7.2. RBI's estimate is 7.0. And the CNBC-TV18 poll was 6.8. So this is a good half a percentage point more than the average on the street. But importantly, the nominal GDP is the same as what the average is on the street. We got a poll of 8.9, and that's the nominal GDP. This is basically actual amount of goods and services produced plus their increase in prices. That gives you the nominal GDP. It's agricultural growth that's dragging it down. Their estimate is this time it will grow only by 1.8%, but services 7.7 and industry at 7.9 are the strong pillars. I've been speaking with Dr. Pronab Sen, Dr. Soumya, Kanti, Ghosh, Madhavi, Arora and Shubhada Rao. Ladies and gentlemen, thank you very much for your patience. Let me come to Shubhada on the note. Shubhada, what do you think is a good estimate of the number going forward? Ultimately, this estimate gives the government the base to forecast next year's nominal GDP and hence deficit. So what do you think they will say?
You're asking about the real GDP and the nominal GDP?
And nominal, more importantly, nominal, really.
Yeah. So nominal, I would think, would go up to 10.2 or 3%, for the simple reason that this time, obviously, the wholesale price index numbers would have brought it to a very lower number of nominal GDP.
That's right.
But going into the next year, we could see some improvement, even if our own estimate of real GDP at 6% and about close to 5%, 4.8% on an average is CPI. But if I add the WPI, I would think it would be broadly in a band of 10.5% is what I would think would be the nominal GDP. As far as the elements of growth are concerned, Latha, taking forward from what Dr. Sen was also alluding to earlier, our worry would be consumption. Now, between the rural and urban consumption, to my mind, would start emerging to be a worry on two counts. One is obviously the leveraged consumption has been now of late correcting. The second part is also related and tied to the underpinning of spending, which is jobs growth. And in many of the surveys in recent times, right until November, we have seen that the job growth actually has been in some pockets showing contraction, particularly from IT, BPO.
Oh, yes.
These kind of elements of job concerns. Absolutely. Would start somewhere impinging on urban consumption also on the downside. So consumption, to my mind, will continue to be a pain point for some time. And to the point of capex, I would think the point that we continue to, I wouldn't say ignore, but do not discuss as much is not just the corporate private capex, but the household capex, which has been significantly getting better and better post the COVID shock of FY21. We have actually seen that growing by 20% in FY22. And looking at the sales of dwellings and construction, that is what you would look at household capex related to, has been very impressive. So I would think this year, the forthcoming year, is going to be a story of capex, which is going to get more broad-based.
Well, that'll be good. But Dr. Sen, coming back to the question we were discussing before the break, do you think we can prolong the capex cycle by keeping consumption controlled, apparently the China model, so that productivity and capacity in the country improves? I mean, is that a model that works?
Look, Latha, it's a model that's worked for us as well, right? The question is, how much can you or should you compress consumption? Because capex cannot feed on itself. Consumption is essential for capex to stay up. So there has to be a balance. So you can have capex couple of percentage points higher than GDP growth and consumption a percentage point below. But you can't move consumption to 3 points below and capex to 6 points above. That is not sustainable.
Fair point, sir. At the moment, it's a 6 percentage point, 600 basis point gap.
600 basis points, yeah.
Yeah. So I take your point. It perhaps can discourage further capex.
That's right.
Point taken, sir. Madhavi, Arora, any further comments on any specific element? Trade, hotels and transport, usually the employment-heavy sector, is way below the average services. Average services is 7.7, but this is only 6.3. Is that a bother?
Yeah, so it again sort of ties up to the fact that, the informal sector hasn't really caught up fully to the pre-COVID trend, which again, to some extent shows the rationale why as to, you're seeing a divide within the consumption, strata. And again, it, brings us back to the whole point of why there's been a disconnect between, capital expenditure, so the capital increase and versus the consumption behavior. So again, to some extent, I think capex as well as consumption generally have been endogenous historically. This is the first time the kind of gap that we're seeing between the two is looking to be a little bizarre. We'll have to see, how long that sustains, because while you were also mentioning this fact that how much can you really justify a capex-driven economy, but at the same time, you'll have to also understand the fact that at this point in time, the marginal returns of public investment are still very high. So to some extent, the supply side policy push that we are seeing at this point in time, which would lead to asset creation, could also prepare the economy very well for a non-inflationary growth, as and when we see a more structural pickup in demand. India is actually a growth economy which will see a demand-driven consumption story come back, probably in a year or so. So that cannot not lead the economic growth picture as such. But at the same time, a consistent investment cycle, whether it is led by the public sector or followed up by the private sector, eventually could lead to a much more stable economy or non-inflationary growth, as they say, as and when the demand side also picks up. So I think we need to keep that in mind.
That point is very well taken. As the capacity of the economy increases, as productivity increases because of higher capex, as and when demand shows up, it will be non-inflationary. That's extremely a valid point, and that should keep the consumption story going as and when it picks up. Now for winding up comments, Soumya, Kanti, Ghosh, the number itself is a cheerful number. Today we go with a very positive headline that the NSO estimates a 7.3% growth. But what would be the other takeaways?
Yeah, I think Latha, just play me a small devil's advocate at the end of the show. I think the household sector investment is a part of a broader definition of the informal sector.
Yes.
So if the household investment in physical assets is actually going up, that implies the informal sector is not doing that badly. This is just a definition from the NSO. So therefore, my speak is that while we may debate over and consumption growth of 4.4% in the overall and investment growth is around 10% full year, I believe that the headline numbers do paint a story which shows that India's growth rate, I think no one at the beginning of the year could have expected that India would land up with a growth rate of 7.3%. Most of us were below 6%. So from that point of view, I think that should be taken with a fair degree of optimism. And let's hope for that the consumption also picks up in the coming days.
Okay. Well, I take your point, but the same data which told us that there were high physical assets also told us that household savings has fallen to a low of 5.1%. Financial savings. So we should worry about that as well. By the way, we must note that the real rural wage growth momentum has really fallen. So that ties in with the lower consumption. Per se, that's a humanitarian worry for a country where already per capita income is just about 1.2 lakh rupees. We should worry about that. Dr. Sen, winding up comments, sir.
As Soumya said, I think, we go away actually feeling quite good.
Yes.
But at some point, we have to really ask the question that are we in a situation where we are going to depend upon the now totally discredited trickle-down theory for growth to actually affect people's lives in a very, very positive way? And that's where the consumption story worries me. I hope that turns around quickly, but at the moment, I'm not holding my breath.
Okay. Well, point taken, sir. Well spoken. Thank you very much, Dr. Sen, Soumya, Madhavi and Shubhada for parsing the numbers for us. The key takeaway from the GDP numbers is as follows. One, the real GDP number is a stunner at 7.3%. This is way above the 6.5% which the Reserve Bank thought in the beginning of the year, and the large part of the market thought would be only 6% at the start of the year. So it's a stunning performance. But going below the line, the nominal GDP at 8.9% is a small bother because the budget had estimated the nominal GDP for the current year at nearly 11%. So a fiscal deficit of 5.9% of a 301 lakh crore GDP will now have to be 5.9% of 296 lakh crore GDP. And therefore, the fiscal deficit will have to be trimmed by about 37,000 crore rupees. That's not a tall ask at all, but nevertheless, that's an outcome of the nominal GDP number being lower than the budget estimate. A third takeaway is that industry is very strong at 7.9%. We've been wanting to be a manufacturing economy, and that's kind of, working well. The manufacturing sector has grown at 6.5% and industry as a whole at 7.9%. A fourth takeaway, which is a little worrisome, consumption growth is only 4.4%, whereas capex growth is 10.3%. Capex will grow, but at some point in time, it will want consumption to catch up, and people may not invest if they don't see consumption growing. Of course, growth trickles down, but if consumption doesn't pick up, then it means that the trickle-down theory isn't working. So we would worry at a later date if consumption doesn't pick up. That's a wrap on this special broadcast on the state of the economy. Thank you very much for watching. There's more news and headlines lined up for you.